Hit it.
It's Friday, April 2nd, 2021, episode 125. I'm Patrick Ceresna.
And I'm Kevin Muir. This week is a shortened show as we give Lena a well-deserved Easter break from producing our mess. But we have a great interview with Guy LeBas from Janney Montgomery Scott. Guy is the chief fixed income strategist and takes the time to explain bond auctions, why the SLR isn't a big deal, and why when equity traders start talking about issues going special, it's time to go the other way.
And we'll be back to our normal format next week. But before we get to our interview, Kev, please give us our disclaimer.
Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in the show. Side effects of too much huddle may include unwanted SPAC spittle, FOMOing at the mouth, and finally the Reddit red eye. Big thanks to Kevin for those.
All right. Okay, we're going to get to the interview, but please note that this was recorded Wednesday, March 31st. Let's do it. We are pleased to welcome to the show Guy LeBas, Chief Fixed Income Strategist at Janney Montgomery Scott. Welcome to the show.
Thank you. Thanks for having me. And as I say here in Philadelphia, how you doing?
So Guy, you're a fixture within the bond community. But for those who don't follow the sector of the market as closely, why don't you tell our listeners a little about yourself and your role at Janney?
Sure. Well, I've served as Janney's chief fixed income strategist for, I guess about 15 years now, not quite. Prior to that, I worked in New York at a couple of organizations, including the formidable U.S. Trust before it was acquired. But at Janney, my primary role is to share some intelligence about what can be a very opaque market, the fixed income market, with our clients who have about $115 billion in assets that are at Janney.
So, Guy, it's Kevin here. I've been looking forward to this for a long time. I guess you were just reminding me that we were supposed to do this before the world ended.
Yeah, so back, I think it was last February, and by last February I mean 2020, we were chatting, and we had a bit of a delay, I think, for a million reasons. Not the least of which was this awful public health crisis, but also a sharp change in financial markets as well.
That's right. So, there's a lot of things that have changed in your sector of the market. And now, all of a sudden, from being something that not everyone was focused on, it seems to be that all I get onto Twitter or go watch the news, and all everyone's talking about is this bond crisis, this problem. And what I love about you is your willingness to say, "Hey, wait, this isn't as bad as everyone thinks it is, and why don't we shed some light on this and throw some cold water on these terrible ideas." So let's jump into it and kind of talk about that. One of the things that I've noticed is that a lot of people seem to think that we are one auction away from the bond market failing. Why don't you tell me your opinion about that sort of narrative?
Yeah, happily. So it's never a good sign when all the equity traders are talking about Treasury auctions. That usually means something's a little bit broken. But the U.S. Treasury Department is selling billions, even trillions in absolute terms, less than that in net terms, of debt. And they've been doing so for a few years here. And to summarize the fear or the Twitter paranoia writ large, there's this concept that at some point the U.S. government could go to sell $35 billion worth of bonds at their monthly 5-year auction, and nobody would show up to buy them. And what would that create for the U.S. budget deficit, for financing the government, for other financial markets? That is not going to happen, right? One of the great things about the U.S. fixed income market is there is demand out there, whether it be from banks, insurance companies, foreign central banks, more recently our own central bank here in the United States. But there is a huge amount of demand for U.S. Treasuries. And the demand really comes down to one simple thing, which is that we import a lot of goods. And we pay for those goods, and I say we, speaking as the United States, we pay for those goods in dollars. So every day, every hour of every day, every second of every hour of every day, we're shipping dollars overseas. And foreign investors, have a couple choices, but all those choices, what they come down to is investing back in U.S. assets, the safest of which generally are U.S. Treasuries. And so as long as that situation maintains, and it will for our lifetimes, I expect, as long as that situation maintains, the yields, the prices in the U.S. Treasury markets will move, sometimes substantially, but there will be enough demand to be able to fund the U.S. budget deficit and sell those bonds.
Right. So why don't we talk a little bit about the specifics, because you're in there, in the nitty gritty and actually know how this works. And for us, equity traders that only see these auctions, why don't you walk us through how it works, what a tail means, what everyone got excited about on that 7-year the other day, and just kind of, walk us through the steps that of a typical auction.
Sure. So each month, as I alluded to a few moments ago, the U.S. Treasury Department auctions off a series of notes and bonds. The most typical that we talk about range from 2 years, so the shortest term note, all the way out to 30 years, which is the longest term bond. There's some other what we call cash management bills and short-term bills in between, but we're really focused on the intermediate to longer term stuff. These auction dates are scheduled well in advance. It has been the Treasury's policy for decades to be regular and predictable in the way it sells bonds, so as to ensure that demand is always there, and create that stability of the market. And so at the beginning of the quarter, the Treasury Department announces how much it's going to sell in coupon securities, these again 2 through 30-year securities, and what dates they're going to sell it on.
Okay.
At 1 p.m. on the assigned date, the U.S. Treasury Department the Federal Reserve Bank of New York, as agent for the U.S. Treasury Department, conducts the auction. They accept bids from potential buyers, and those buyers can include entities that bid directly with the Fed. They include banks. They can include foreigners that bid indirectly through other entities. But the Federal Reserve Bank of New York essentially collects all this information, and then announces shortly after 1 p.m. on the day of the 2-year note issuance what interest rate is required and what price is required to make sure all the bonds are sold. In the typical auction, it varies. There is roughly 2 to 2.5 times as many bids as bonds being sold. So there's sufficient demand. So not everybody who bids at an auction gets their bonds, but the price to everybody is the same. The auction clears at a single price.
Okay.
You asked a question about a tail. So we have a pretty good idea of approximately what price is going to clear the market at auction, because there's an extremely liquid market in treasuries of all maturities, right? Especially what we call on the runs, meaning the most recently issued treasury. So 30 seconds before that 1 p.m. 2-year treasury auction, we know the 2-year treasury note is yielding 0.149%. If at auction, the resulting yield is higher than 0.149%, and I always do this, I always back myself into the corner with numbers that are too long and arithmetic that's too complex to do on the fly. If the price at auction is higher than secondary market trading levels, we call that a tail. Okay. So in my example, if a price at auction is 0.16%, 16 basis points, then we'd say there's a 1.1 basis point tail. If, on the other hand, the price is below, say it were 0.145%, then there would be 0.4 of a basis point through secondary market trading levels. Generally, most auctions tail a little bit. I don't have the statistics in front of me, but it's in the neighborhood of, 1/4 of a basis point. It's usually pretty close.
Right, okay. And what happened the other day with the 7-year? There was a 7-year that tailed large, right?
Yeah, it tailed pretty large. So last Thursday, I believe it was, I'm also bad with days arithmetic. I guess that would be, the 26th?
Guy, it's okay. It's not like you deal with numbers for a living or anything like that.
I tell you, date count arithmetic is like the bane of every bond trader's existence. But so it was whatever it was, 5 or 6 days ago, last Thursday. The U.S. Treasury Department auctioned off their monthly 7-year auction, and the 7-year sale is pretty significant because it's a really liquid issue. The reason is that it's the closest maturity to where most of futures markets trade in the 10-year Treasury futures. So it's a pretty liquid sale. It's very large. It's one of the largest sales. And basically it tailed, meaning that the price at auction was roughly 1.5 basis points above where bonds were trading prior to auction. where the 7-year was trading prior to the auction. That's a pretty decent sized tail. But if you look at what happened afterwards, it wasn't like a bunch of bond traders were running around with their hair on fire. Clearly the markets had prepared for this expectation pretty well, and trading after that auction went much more calm.
Okay, so there's a big short position out there in a lot of the futures markets and the Treasury futures markets, and there's a lot of people with the bond bear narrative is getting quite prevalent, and where it used to be I would be quite alone in my bond bearishness and used to love to make fun of me, Guy. Now all of a sudden it's like I'm
You'll notice I stopped last June, by the
way. No, you're absolutely correct, and you're right, you've gotten bearish as well. I saw that. And the one thing I wanted to kind of chat with you about is this bond kind of short narrative that's out there. And one of the things that you did that was really helpful for me was that you took the time to explain what it meant when an issue goes special, and why that those who were claiming that the 10-year going special was a big deal, it actually wasn't that big a deal, and it's very typical. Sure. So if you could walk us, our listeners through that, because I thought it was very helpful for me to understand the mechanics of how that worked.
Okay. I'm thinking about how I want to address it. I'm going to break it down into two parts. First is the bond short base. So, a lot of what you're probably looking at the short base is CFTC positioning data on Treasury futures. And while that is material, there's many, many other interest rate futures that often have more leverage and more volume, such as Eurodollar futures. And you can only really look at it in combination. Moreover, one of the most popular sort of levered trades is what's known as the basis trade, which is essentially being long or short Treasury futures versus long or short the cash, the actual underlying security. And so CFTC futures positioning data is a pretty good way to be sure you're getting distorted information on how many shorts are actually out there. Right? It's very not clean data because it interacts with so many other markets. Okay. So that's my first point. My second point, specifically with regard to the 10 years. So I guess this was, call it beginning of March, middle of March. And the 10-year Treasury, on the run Treasury repo went on special. So I'll start with talking about what on the runs are, why this can be a seasonal thing. I'll also talk about a little bit about what being on special is in the repo markets. So a lot of stuff to go over. I mentioned the Treasury Department auctions their securities on a regular basis. Every 3 months, there is a new maturity and new coupon 10-year Treasury note. So the 3 months, I'm not sure why it is, but the 3-month period is February, and then May, and then July and October. Other notes and bonds have sort of different periods. But the first time that the Treasury Department issues a given coupon and a given maturity is, for example, last February. And when the Treasury Department does that, there's however many $1 billion of that bond outstanding, that note outstanding. Then the next month, in March, they issue another however many billion. So, for example, the 10-year Treasury note comes out and it has relatively limited supply, let's say for sake of argument, 25 billion. And then a month later, the Treasury Department issues another 20 billion to increase the total supply to 45 billion of that specific security. Right. Now on to repo. Repo is a source of financing, of borrowing. If, in this case, you want to short the 10-year Treasury note, the actual note, rather than in futures, you would have to borrow it and then sell it. And so the rate you pay on that is the repo rate. When a security goes on special, what that means is a very specific security, as measured by a single CUSIP, not a group of securities, has an unusual borrowing rate compared to the broader market borrowing rate, which we call a GC, or general collateral repo. So essentially what was going on here back in early March is the Treasury Department auctioned their new 10-year back in February. It's the first time the security got auctioned, and there basically wasn't enough of it to go around for the number of people who wanted to short the security. However, we knew, right, because the Treasury Department issues regular, predictable, and with advance notice in our auctions, we knew ahead of time that there would be a huge increase in supply in March, right? And so when that security, that borrowing cost became highly negative, went on special, it meant a lot of people were shorting it. But the supply and demand imbalance for the shorts basically cured itself once that next 10-year Treasury auction came around. And frankly, it's not that unusual, right? A lot of times after a 10-year or even a 30-year comes out, it does go on special. It's not that uncommon.
You got to chalk it up as another example of when equity guys start talking about bonds on special to ignore them.
Yeah. And look, the timing was pretty awkward, right? We had that the last couple of days of February, first couple of days of March, we had a violent upheaval in the long end of the U.S. yield curve, and that seemed to infect tech stocks as well, right? And so the equity world kind of drifted over towards fixed income very quickly.
Okay, so Guy, you've done a great job explaining to us the kind of some of the plumbing of how it works. I'd actually like to step back and think about this from kind of a bigger perspective about your career and how it might have changed over the last couple of decades. You were mentioning earlier to me that when you started out, you were an analyst and you were looking at macro variables and booms and busts and then all sorts of different things, and how now it's actually changed and the plumbing, the financial plumbing ends up being more important. Why don't you walk us through that evolution?
Yeah, it's pretty strange to me, right? You think of somebody who's maybe a REIT equity analyst, right? And they spend their career on REITs, or just a broad equity market person might spend their career just on equities. Within fixed income, you probably assume the same thing. I imagine you probably assume that most of us are pretty boring people, but no, I lead a very rich inner life. But what I think is really fascinating about the last 20 years is, which is essentially my career span, is that there have been periods where having a certain skill set was really useful, and then having that skill set a year later or 2 years later was incredibly useless. So there's been a lot of dynamism kind of underneath the surface. It's my new favorite word. But in the early 2000s, one of the biggest relationships in the fixed income market was essentially the popping of the equity bubble, the big tech bubble, and how that influenced demand for safety. And fast forward post the what was then the low in rates, courtesy of Alan Greenspan. Post that low in rates, right? What mattered was the monthly jobs report. I remember a period in which a single day in which the jobs report missed expectations, and the entire day you couldn't get a bid on a bond because everybody out there was so worried about their own P&L that, since they were overhedged, everything was wrapped around these macroeconomic expectations. As that drifted on, right, 2 years later, we were in the midst of the housing boom, and everybody had to care about, in order to understand what was happening in fixed income, they had to care about booms and bust cycles. And I guess that was around a few years later, but the irrational exuberance of the housing markets. And, finally, post 2013, we've kind of settled on something, at least for the last, it wasn't obvious until maybe 2019, but we've settled on something in the fixed income markets that's really important, which is market plumbing. And what it comes down to, at least in my view, is having an understanding of sort of, best way to describe it is, but how a number of contradicting variables interact with one another as a system. So let me digress for a moment here. One of my favorite things to listen to is airplane crash reports. Not on the news. Okay. I got that chuckle in the background, right? It's really morbid, like the Gimli glider in the early 90s. I think that was.
Oh, you know about the Gimli glider?
Of course, right?
Well,
so
why don't you tell people about the Gimli glider? You can't mention
Gimli glider was the Gimli glider was a 767 flown by Air Canada in I'm pretty sure it was the early 90s. I think it was 93, but I might be wrong on that.
No, you're off by a decade. It's 83.
Oh, it's 83. Okay, I had the 3 right.
Okay.
A very visual memory. So the Gimli glider was an aircraft that, because of a series of awkward coincidences of both fuel meter malfunction and essentially areas of the country changing over from kilograms to pounds in their measurement, so basically an arithmetic error, a 767 that ran out of fuel right over the middle of Canada and had to land in an abandoned airbase.
Right.
That was apparently hosting like a drag racing competition at the time too. Anyway, so I like to tease about that one. Of course, given your provenance, that's why.
Yeah, that's right. Actually, my father tells me the story of that when they landed the plane, the people came with the fire truck, showed up, and they said, "Don't bother. There's no fuel in it."
Yeah, nothing to light on fire.
And by the way, you're showing your American bias there by when you're saying that they were going from kilograms to pounds. It was the other way around.
Oh, did I switch my preposition?
Yeah.
My bad.
Yeah, it was when we were converting, because at one point Canadians were on the imperial and then we moved to metric, and then they made mistakes.
Yeah, that's quite the mistake. Several people made it, actually.
Right.
Anyway, so where I'm going with this is that we solved, as a society, the easy problems of commercial aviation a really long time ago, right? The basic, you pull back on the stick, the plane goes up type problems. What we haven't solved, and the only problem that remains, are problems created by complex systems interacting with each other in unpredictable ways. Okay. And essentially, a lot of that echoes what I see today in the financial markets and the fixed income markets. Right? When market plumbing breaks, and it reverberates throughout bonds, throughout stocks, pretty much every financial asset, when market plumbing breaks, it's inevitably the result of an interaction of complex and very hard to predict systems. And so that's where I wrap the reading and listening to airplane crash reports back into the financial industry. We're not dealing with life and death on an everyday basis, but the interactions are surprisingly similar, at least in concept.
So like almost the law of unintended consequences. Now, would you put the SLR, why don't you explain to people what the SLR is, and maybe explain in the context of these interactions what that does and what maybe are the concerns about the SLR going forward?
Sure. So I'll talk about the SLR, but before I talk about it, I'll say that you don't have to care about the SLR.
Okay. So tell us why not.
If you want to go get something from the fridge, grab a beer, now's the time to do it. So the SLR is the acronym for the supplemental leverage ratio. It's one of three primary leverage ratios that regulators here in the United States hold large banks to. So the whole idea of capital ratios is to ensure that there's enough owner's equity at risk in a bank that if that bank experiences loan losses or whatever sort of losses, the owner's equity gets hurt and the financial system doesn't collapse, and the Fed and the FDIC and all those other government entities don't have to bail them out. The SLR and these other two capital ratios, which I'll touch on in a minute, they came out of the Basel III Capital Accord. They were sort of formalized in the 2013 Dodd-Frank regulations here in the United States, along with a bunch of other stuff. But they apply predominantly to GSIBs, global systemically important banks. The other two capital ratios that apply to these entities are something called the TCE, or the Tangible Common Equity Ratio. That's really not very binding for the most part, so you don't have to worry about it. And something called GSIB scores, which is calculated with some 19 different sub-scores in a way that I can barely begin to understand, even with a halfway decent knowledge of partial differential equations under my belt. So why do we care about these three things? Well, they're new since 2013, and they put limits in banks' ability to do things in kind of hard-to-predict ways, right? We're creating a complex system that interacts with millions of other financial variables in a complex and hard-to-predict way. So the first place that this became a problem was starting in 2018. In 2018, in the United States, we essentially started running a pretty large budget deficit following tax cuts. And when that happened, we issued a bunch of treasuries to fund the budget deficit, as the United States is supposed to do. Totally normal. But because of a range of different coincidences, including the shape of the yield curve, which is pretty flat, the cost of currency hedging, and relative overnight interest rates compare in the United States compared to that in other countries, essentially it was really inefficient for foreigners to buy our debt. So what happened? U.S. banks bought the U.S. Treasuries, and they borrowed from foreigners on an overnight basis in the repo markets to go buy and fund and hold that debt. So all of these machinations and the incentives around them were actually created in large part by those banking regulations and also a similar insurance regulation called Solvency II. And what it incentivized foreigners to do, foreign banks and insurance companies, was just to hedge their interest rate risk exposure. And also that kind of, again, interacted with these various other factors such that all these foreign investors wanted to remain short. The U.S. Treasury Department was issuing intermediate and long-term debt, and banks served as the intermediaries, buying up the long-term debt, hedging it, and then borrowing short from foreigners.
Okay.
All right. So a lot of messy stuff there. Fast forward to when I first was in contact with you guys in early 2020, and essentially banks' ability to buy more of this stuff, their ability to absorb additional debt was constrained by two things: the SLR, the supplemental leverage ratio, and their GSIB, or globally systemically important bank scores. That would have been all fine and good, except that in March of 2020, every corporation on the planet suddenly need to borrow a lot of money. And the combination of large portfolios of treasuries and the sudden demand from corporates to draw down on their line of credit really strained banks' capital.
Right.
And part of that was because of these new capital ratios, the SLR and the GSIB scoring, as well as how they interacted with demand for currency hedging from foreign treasury buyers. Again, complex systems interacting in complex, hard to predict ways, some of which have very fixed rules, right? Capital rules.
Right.
That's about 20 minutes of prelude for what I was going to say.
Okay.
So the Fed relaxed those rules to give banks breathing room in March of 2020. One of a number of measures. Essentially, the Fed was throwing a lot of stuff at the wall, I think appropriately so, but throwing a lot of stuff at the wall, trying to figure out what helped. And it turns out that the SLR exemption, essentially the Federal Reserve said, hey, banks, you don't have to stick to this SLR ratio when it comes to treasury holdings. Okay. So you can take your treasuries and you can take them off of the ratio. And so this whole portion of their balance sheet was no longer binding for capital standards. The Fed also hooked certain requirements around that, right? If a bank chose to accept that exemption at the bank operating company level, that bank couldn't pay dividends. They couldn't buy back shares.
Okay.
Right? So as it turns out, most banks didn't choose to accept the SLR exemption at the bank operating company level. So fast forward 12 months, when this exemption is ending, it doesn't actually affect most banks because they didn't choose the portion of the exemption that's ending anyway. It's kind of become like a market scare story without any meaning behind it.
Oh, I had no idea. I didn't realize that they didn't kind of opt into the SLR exemption.
Yeah, and look, I can't, as a strategist, I can't talk about specific companies.
Yeah, no, we're not asking, but I'm sure you could Google it. It doesn't really matter. The point is that the big ones, I'm assuming the biggest ones probably didn't do it. So therefore, that's...
Yeah, there's a handful of big banks in the country. There's two that are maybe constrained by the SLR. There's one that has publicly said, we're not constrained by the SLR, we're constrained by GSIB scoring. And there's another one that's under an asset cap that doesn't really count anyway because they can't increase their asset size.
That's fascinating stuff. Now, I would love to talk about that March COVID crisis. And one of the things that I thought was unusual was usually when you have a crisis, you see bonds going bid. And yes, maybe corporates, go offered, or even Eurodollars go offered because of the credit component. But it's very rare that you see the full faith and credit of the U.S. government going no bid. Talk to me about, have you seen that before? Was that as unusual, or is that typical in a liquidity kind of event? Maybe just give us a little bit of color on that period.
Yeah, there was one day in particular where I think I must have picked my jaw off the floor 4 or 5 times. I think it was March 24th, but I forget the exact date. Essentially, long-term treasuries, they're supposed to be a source of safety in volatile times. And so investors go and buy them, sell their stocks, sell their risk assets, and buy long-term treasuries when things are going haywire. But for this one day, 1 week, long-term treasuries weren't safe enough, essentially. There was an incredible, just a massive rush to settle margins. So this plays a little bit into the story I told about capital ratios and bank balance sheets. Essentially, banks were capital constrained in March of 2020. And so they needed to reduce the capital they provided to their primary dealer, their broker-dealer subsidiaries. And to some degree, that meant calling in loans. And the only way to settle a margin loan, right, is to settle with U.S. dollars. It's dollar denominated. So if you're a hedge fund that owns treasuries and your bank is saying, hey, we can't lend to you right now, the only way to settle that is to sell those treasuries and hand that bank cash. And that's a good part of what happened. The other part that's very much integrated with that theme is massive basis trade blowups, just massive. There was a hedge fund that was run by I don't want to say that. I don't want to give the parent company
the
wrong name.
It's a big hedge fund out there.
H2O. That and this is all very, very public record. H2O that had massive basis trades on, essentially long bonds and short similar maturity futures, and the spread on this trade, it shouldn't move very much,
right?
But it moved something like 20 standard deviations in 12 and a half minutes, and so their basis trades essentially blew up. It was also the day that you saw things like the U.S. dollar rising 8% versus the British pound intraday. Okay. I mean, that shouldn't happen, right? Not unless the UK is at war. But that's the sort of thing that happens when the only way to settle margin calls is to raise dollars at any cost. Like financial market valuations get pretty wiggy.
And then that was the point at which the Fed just said, we'll buy it all, right? And they came in and they just started doing QE like we've never seen before.
Yeah, that was sort of in that process, right? So my expectation is that a lot of the big banks' primary dealer subsidiaries, they ended up stuffed with a lot of treasuries, right? Because their clients had to sell them to somebody to raise cash. And so these banks and primary dealers ended up with a lot of treasuries in their balance sheet. And, the phone call down from the treasurer of large New York bank A's, B's, and C's went down to Maiden Lane downtown. And I guess it was it John Williams at the time? I think it was Williams at the time. He picked up the phone and said, hey, guys, what's up? And they're like, oh, here's what's up. You need to buy our treasuries. Right. My guess is there was a little bit of that. But there's a very symbiotic relationship between the Federal Reserve and the globally systemically important banks, and as their role in the Treasury market.
Right. Okay. So now let's back up even further and talk a little bit about the fact that we have had this monster rally in treasuries up until that COVID crisis, and since then we've entered into a bear market. What's your expectation about what's going to happen going forward? And maybe you could explain to us what you think has been happening over the last 9 months of this treasury bear market.
Yeah, sure. So 9 months of a bear market doesn't seem that long. The last month has been the longest of those months, that's for sure. Look, since 2017, not every year, but I shouldn't say, 2007, excuse me. Since 2007, not every year, but most years, I've been on the more bullish side of street treasury yield interest rate forecasts. Essentially, I've been betting that inflation expectations are coming down, intermediate to long term, and that the market hadn't fully believed that was going to happen, that inflation really was going to remain sub 2% for such a long time. I think we pretty fully incorporated those expectations in 2020. And more than that, there was a very large safety premium in the Treasury markets. Since the lows in yields in August, there's been a really big increase in inflation expectations. We're now at the highest level in about a decade in round numbers, call it about a 2.4% 10-year inflation expectation. That's actually a good thing. That's signaling the markets think Fed policy is going to work. And in addition to that, the sort of safety premium is gradually bleeding out. As you alluded to, my first bearish note on the Treasury complex in some time, I published that in the end of June in our mid-year outlook, June 2020. And once again, I published a gently bearish forecast for 2021. I think for the moment, we're probably a little bit oversold here, but the trend is definitely towards higher interest rates. And to harken back to a little bit of an earlier conversation we had, right? To be successful in the fixed income world, you had to be, first reflecting stocks and then analyzing macroeconomic variables and so on and so on. The next couple of years, if I had to guess, the way to be an expert in the fixed income markets is to have a good understanding of how what's going on in fiscal space is going to influence not just supply of bonds, but also macroeconomic variables that bonds embody, right? So we're in a situation in which fiscal decision-making is largely in control of where we go. My guess is that on a 2 to 3 year basis, we continue to see yields drift a bit higher. I am hard-pressed to see a scenario in which 10-year Treasury yields much exceed 2.5%. But it could happen. And I think for the moment, like I said, we're probably a little bit oversold. But I also made that call about 15 basis points ago, so I think I've lost my right to have a short-term opinion.
I like that. So can you tell me why you think 2.5 would be the worst that you'd see on in terms of a bond bear market?
Yeah. So what it comes down to is what is the overnight interest rate going to be 100 years from now?
I don't know. I'm hopeful I'll be around, but I'm not quite sure I will be.
We'll all be bits and bytes on a computer. Hopefully it'll be after the singularity. So, I mean, I'm joking a little bit that, but essentially it comes down to having an idea or a guess of what neutral interest rates should be. Neutral interest rates is a rate of overnight interest that is neither contractionary nor stimulative for the U.S. economy. A reasonable guess of what this number is in today's world is 0% real interest rates. So in other words, neutral interest rates should be about the rate of inflation. If the Fed's successful in what they're doing, the rate of inflation should be around 2.5%. So neutral interest rates, I'm thinking, should be about 2.5%. And it seems really unlikely that long-term interest rates are going to materially exceed what a neutral level of interest is going to be for this cycle. Maybe in the future, but for this cycle, I think that's probably the peak. When we hit it is another question, right? It's something that I think the markets are grappling with rather acutely right now. And you see that trading, based on trading in Euro-dollar futures in particular, which is where you see most of the leverage on short to intermediate term interest rates. Okay,
so what in terms of switching to being a little bit more bond bearish, can I ask what were the triggers? Like you mentioned fiscal and this move from kind of a monetary dominance to a fiscal dominance is one of the things that people have been focusing on and kind of wrapping their heads around. Is there anything else that has made you more bearish? And ultimately, you don't have any worries that they're going to overdo it on the fiscal side?
So on the first point, what's made me more bearish, or from time to time throughout the last 15 years or so, I have issued somewhat bearish forecasts. And they tend to be, periods in like mid to 2016, for example, when rates bounced off that Brexit bottom. But essentially, there were two pieces to it. One is that on inflation, there have never been, I shouldn't say never, it's the wrong word. It's been 60 years since there have been so many forces leaning on the inflationary side of the fence in the United States.
Okay.
And so odds are that against that backdrop, inflation expectations will pick up. And so what are those various things? Well, one is the Federal Reserve, right? Around the middle of the year, the Federal Reserve signaled through, I can kind of go into the means, they actually started signaling in summer 2019, but it became more clear that they were going to, as part of their framework review, alter their method of targeting inflation. So in addition to the Federal Reserve, right, the fiscal stimulus created some substantial demand pull inflation. Shortly after the CARES Act was passed, there was already talk about increasing the degree of stimulus, right? So the zeitgeist around fiscal spending had changed in a subtle way. So we've got monetary stimulus from the Federal Reserve. We've got demand-driven inflation from fiscal stimulus. And then you've got cost push inflation, right? Around that time, oil prices, I hesitate to say bottomed, drilled a hole in the ground. I don't know what the appropriate metaphor is here. And, commodities prices, kind of cursed thing to say in financial markets. Commodities prices at that point only had one way to go, which was up.
Right. When they're negative. When they're negative.
When you get to the bottom of a hole, stop digging. Who would have thought somebody walked out of, and I'm borrowing from an acquaintance, somebody walked out of a wet market in Wuhan with a bat in one hand and a pangolin in another, and 9 months later we're up to our eyeballs in crude oil. But it's one of, again, complex systems fail and do strange things in complex and hard to understand ways. Philosophy. So commodities prices had essentially one direction to move. And the final piece is cost push inflation from a higher cost of providing services. Now, some of this has been mitigated by the vaccine news, which is wonderful, probably the most amazing public health advancement, certainly the fastest in human history. I'm really, really impressed by that. But, at the time, if you had to, summer 2020, if you had to imagine going out to a restaurant, like a restaurant required more floor space. It's not that its customers were eating more food, but it required more physical space. And you multiply that times a million other services activities in the U.S. and world economy, and you can see where that cost push inflation could come into play. So all these forces leaned inflationary, and we haven't seen anything like that since the 60s. So that's sort of bearish source number one. And bearish source number two was as I mentioned, the philosophy around risk-taking was changing. And I expected that would push real interest rates up over time.
Okay.
A bond sell-off is definitionally self-limiting. Why? Because bonds generate income, and at some point that income becomes so attractive, people buy it, even if they think interest rates are still likely to move higher. Where is that point? I don't know. We don't seem to have reached it yet. We have reached it actually in municipal bonds, but we don't seem to have reached that in treasuries.
Okay. Now, one of the things I actually wanted to touch on, you mentioned that the Fed had changed their stance, and obviously they've taken up average inflation targeting, and there's no doubt that the Powell of 2018 when he joined as the Fed chair and the Powell of 2020 and 21 is a dramatically different fellow. One of the things that I've found interesting is that, previously the market used to try to bully the Fed into lowering rates. It almost seems like the market is trying to bully the Fed into raising rates. Could you talk to us about what's going on there, and is the market misinterpreting what the Fed is saying?
So there's an old adage in fixed income markets is that the Fed tells the markets when they're going to hike, the market tells the Fed when they're going to cut.
Okay.
Yeah, we actually saw that in 2020, right? Interest rates came down, and then the Fed had to cut. So it's I guess a little bit of a reverse in some respects. Yeah, I mean, you've got Jay Powell scheduling 47 events per week that are televised, and his the other brain trust at the DC Fed, Clarida and Brainerd, very publicly, very out there saying, "Hey, we have zero plans to remove any accommodation, zero plans to tighten. It's probably going to be a while. I don't want to give a date on it." But, you just kind of do the arithmetic in the calendar and you think maybe late 22 at the soonest, maybe 23.
Right.
And what fixed income markets have kind of done, specifically Eurodollar futures markets, is they've drifted to pricing in a goodly number of rate hikes in 2023. I think it was 4 or almost 4 at last glance. And so that's kind of the portion of the market that's pushing the Fed more so than long-term interest rates. And I don't know, so there are different philosophies about how people think the Fed provides stimulus. My view is they do it through the entire yield curve, so interest rates across the curve, even though they only control, in essence, short-term interest rates. And so at some point, they'll care about this trend, but they'll probably care about it in terms of words. And so far, Jay Powell, who incidentally has the same microwave I do, it's one of the nice things about getting to see people at their home on Zoom. Jay Powell, so far, he doesn't care to push back against this. So I wouldn't describe it as a markets bullying the Fed as so much as markets being markets and placing a bet, and one which the central bank doesn't feel compelled to push back against.
Okay, so that's another great point in terms of the fact that bonds as the yield curve gets steeper, we're going to have more of a carry. And one of the things that I heard someone talk about the other day is that be careful about assuming a bond bear market has the same return profile as the bond bull market. It won't, because of the fact is that we've had some carry. Why don't you talk to us about that and about the difficulties about being short the fixed income market?
Yeah. So, it's pretty easy to imagine how being short could cause pain. If you're short, in the long run, you're basically paying out the coupon.
Right.
And that's negative, right? That's a cost to carry. So it's hard to be short for a very long period of time, because year in, year out, you're going to be paying out that whatever 2-3%. And at some point, that cost becomes higher and higher and higher.
And
so,
sorry, go ahead. I didn't mean to interrupt.
The reason the sort of bull market and the bear market don't have identical return profiles, even if interest rates move the same, you could call it convexity, but I'd rather just describe it in simple terms, is that, as interest rates came down, right, you earned price appreciation on the bonds plus coupon or interest income. On the way up, even if they move the same amount, you'll lose roughly the same amount in price appreciation, but you'll still have this positive influence of income, of coupon, of yield. And so it's a little bit more muted. In addition, again, at some point, we're going to find a pretty strong level of demand, particularly if the yield curve is relatively steep, for foreign investors to come out of their hiding places in the short end of the curve, where they're still a little bit biased by my arithmetic, and move further out on the curve. And there's a chance, not saying it's certain, but there's a chance that this could start on April 1st, which is tomorrow.
There's a chance. So one of the ideas, there's always a chance. You're like the Dumb and Dumber guy. You're telling me there's a chance. So one of the ideas in terms of you are bearish, I guess that's what makes the Steepener trade a lot more attractive, because you're earning the carry at the front end. And especially if we have a Fed, a Fed that is not raising rates, even though the market is priced in rates, that could make that more attractive. Would you agree?
Yeah, definitely agreed, right? So a steepener is essentially your short long-term interest rates and balance that out either at a nominally equal basis or a duration-weighted basis by being long the front end of the curve. And there's lots of different steepeners you can do out there. 2s, 5s, essentially. You're long the 2-year note, short the 5-year note, or that portion of the curve, right? That's been turning steeper a good bit lately. 10s, 30s steepeners have kind of been in vogue lately. So 10s, 30s is a little bit more complicated because it's more about trading levels and trading flows. Complicated to me, at least, as somebody who likes to deal in economic variables and plumbing. But that is a much less negative carry way to institute a bet on higher interest rates. Many prop trading organizations, for example, require a long leg as part of that trade, right? You can't have just a single naked short position. You have to balance it out. Again, just like higher interest rates, a steepener is somewhat self-limiting because at some level it's going to incentivize real money buyers, asset managers, insurance companies to extend their own duration and buy longer-term bonds and essentially reflatten the curve.
So the real question is, when does that happen? And your argument is that we're closer than we probably think.
Yeah, I think so. And, in particular, it has to do with currency hedging costs. So I was joking about April 1st. I'll tell you in a moment why that might matter. Essentially, currency hedging costs have foreign investors who buy treasuries, not universally, but many, almost certainly if they're banks or insurance companies, maybe if they're pensions, depends on the currency. They usually hedge some of the currency risk, right? So they might do that by putting on a 3-month currency hedge versus a 10-year bond. So there's some mismatch, but they hedge some of the currency risk. And the cost of that currency hedging is a component of the return they expect to generate, or the yield they expect to generate on that bond. And so currency hedging costs plus the shape of the yield curve mean that, particularly for Japanese yen investors right now, buying intermediate to longer term treasuries generates more income than at any point it has. Don't quote me on this. It's a recording. Of course, you're going to quote me on this. But I think since about 2014 or so, which is a really long time ago, and then 10-year treasury yields were 4%. So demand from Japan, I think, will serve in part to limit some of the selling. And I joked about April 1st, but that's the first day of the new fiscal year in Japan. Right? Their fiscal year end is typically for banks and most companies is the 31st. So you might see a little bit of a spurring of demand as a result of that combination.
So when you look at the this complex system that we've created, what keeps you up and what worries you the most?
So, what keeps me up at night actually is I sleep pretty well, first of all. What keeps me up at night, if anything, is what's going to happen to the commercial real estate market. Now, in the last year or so, and I'm sitting in my home, recording this from my home, not in my office, though our office is open. I think it's not rocket science that there's going to be some pretty dramatic changes to the long-term demand for office space in big cities, right? And, a lot of that's secured by commercial mortgage-backed securities or unsecured borrowings from REITs, real estate investment trusts that own that stuff. I don't know how that looks 5 years from now. And I couldn't in good conscience recommend a client buy a long-term, REIT corporate bond that has high exposure to offices or CMBS structure that has high exposure to office properties without having a lot greater confidence that we're going to have people working in large cities and real estate costs are going to be similar as they were 2 years ago, 5 or 10 years from now.
So you don't think the market has fully appreciated the change that has occurred because of COVID?
Many changes, yes. That one, certainly as it applies to the unsecured investment grade debt markets, no.
Got it.
And, maybe Fed policy in the last 12 months, maybe low interest rates have kind of, disintermediated what might otherwise be a harsher market response to those changes. Again, particularly with unsecured debt from entities which have high exposure to tier 1 office properties in large cities around the world.
So, Guy, I know you have to go. You have a date on the peloton, right? You're racing a friend?
I do indeed. We have a wonderful group of financial Twitter people who ride together regularly on a peloton indoors. And my Twitter handle is @LeBas_Janney. And if ever anyone wants to message me, see if we can join the group, we welcome more.
Oh, well, there you go. So those who want to go and ride with Guy, make sure you do that. Now, before I let you go, I have to talk to you about your name. When I first saw it, I was like, a fellow countryman that has gone to the States. A Canadian that has made it in the big city is a big, huge strategist.
Migrated south.
And I was sure that either you were like a left-winger for the Montreal Canadiens, or you decided to do this. Why don't you tell us a little bit about the background of your name? Because you're not Canadian. You are a full-bred American with a Canadian-sounding name.
I am American, as I say, but of French Louisianan heritage. I was forced by name to play ice hockey. Obviously, there's no video here, but I'm about, 5'8", 160 pounds. So I got run over pretty good. Should I convert that into kilograms for you again? So I got run over pretty good on the ice. It wasn't pretty, but I'm pretty good at watching hockey these days.
Well, listen, Guy, it's been great to have you on. Why don't you tell people one last time if they want to follow you on Twitter for, not to ride with you, but to actually learn something about the markets, or where they, can contact or learn more about you and your firm. Why don't you give us the final sign off?
Yeah, sure. Well, thank you so much, Kevin. Thank you, Patrick. Really enjoyed being on here today. You can find me on Twitter at that funny A symbol, LEBAS_Janney, JANNEY. And my 30-second commercial, excuse me, I'm very bad at this stuff. Janney is a wealth manager based here in Philadelphia. We have about $115 billion of client assets that we as a firm manage. And we like doing a very personally involved job. So I'd be happy to put you in touch with somebody more directly who can help you out. And in the meantime, thank you once again.
Thanks for being on. Take care. Good luck on your ride.
Oh, I'm going to get crushed. I'm not going to tell you who's going to crush me, but he's a hedge fund manager on the West Coast.
All right.
Thanks for tuning into the Market Huddle. We appreciate you spending some time with us. Please give us a follow at the Market Huddle. We're on Twitter every day. Lena's there, even though she'll be off this weekend enjoying Easter. But she does get tired of talking to Patrick and myself, so make sure you give her a shout out. You can listen to the Market Huddle on all the networks: Google Podcasts, Podbean, Spotify, Android Play, iTunes, and YouTube. A lot of people watch on YouTube to see all of our charts and visuals, and while you're there, please like and subscribe to get our latest content. Please, if you could, give us a review on iTunes. The funnier, the better. I always love them. I'm still looking for somebody to beat the Dumb and Dumber review. Anyways, Patrick, where can they find you?
All right. You can find me on Twitter at Patrick Ceresna, and you can follow me on my website, bigpicturetrading.com. Kev, where can they follow you?
I'm on Twitter at Kevin Muir, or you can check out my newsletter at themacrotourist.com. And listen, we can never have too many friends. Bear market, bull market. We're just happy to spend some time together on this crazy ride. So thanks for tuning in. Now, usually we say stick around for the after show, but there won't be one. So everyone have a wonderful and a happy Easter long weekend, and we'll see you next week.
Thank you very much, everyone. Have a great weekend.